This is not a recession or a depression on the horizon. This is a new economic global order. Welcome, everybody. Welcome to this edition of Crashes and Taxes. I am your host, Rebecca Walser. I'm so glad to be with you. I have been extensively traveling a lot this summer, and so Crashes and Taxes has definitely been on a summer hiatus. But I've also needed the time really to get ready for what's coming this fall. And what's beginning this fall, and who knows how long this is going to take, but it's definitely beginning. And so today's going to be a special, longer, extended version podcast because I have been accumulating the data and the analytics on what the world is doing and what the United States, especially the investment banks, are saying. And I feel like it's time for us to really take a deep dive into what my perspective is and to relay that to you guys as best I can and as broadly supported as possible. So you can see that it's not just Rebecca Walser's argument, but there are a lot of disruptors, contrarians like myself, that are out there that are now publicly saying, yes, this is coming. Peter Schiff, I think, is probably the one I can think of the most prominent, really believes, as I do, that we are imminently now at the precipice of a total global changeover. So let's get started with what I am talking about today. And I'm just going to quickly share my full screen with you. You can see that I am recording this August 9th. And I am talking today about the top 5 economic indicators that Wall Street is wrong, and we are not going to get a soft landing, that a soft landing is, in fact, not even possible. That is what we are going to be talking about today. So let's get started. Like I said, this is an extended podcast. So if for any reason you need to pause it, come back later, please share this with as many people as possible, especially those that are on the FOMO track right now, which is fear of missing out. You're going to see that even the investment banks are on the FOMO track right now and are very much being peer pressured by this market and not everybody, you're going to see that at the end, but a lot of people are literally fear of missing out, and they are totally jumping on the market bandwagon, even though we are thinking that no, it's not to be. This is a slide that I share with my practice, my clients on a weekly basis, because when you're in a transition period and you are on the right side, now remember, most people lose during any kind of economic transitions. Most people end up being on the short end of the stick. So not everyone's going to come out on the good side of this transition. The ones that are in the know, the ones that take the time to actually do the research or find a person such as myself that has the multidisciplines to walk through the analytics and the data with you. So what is exactly my background? For those of you that don't know, I have my undergrad in finance, graduated top of my class, got a job with Price Waterhouse, worked for the global managing partner for financial services consulting on the consulting services side, the MCS side, management consulting services. And he was based in London. And I did that for 5 years. I went through the global transition to Coopers and Lybrand. So I went through an M&A, a merger. And then I went to IBM, and they were sold in their global networking division to AT&T. And I went through the AT&T IBM global networking transition acquisition. Then I went to law school. I worked in commercial real estate finance and commercial finance. Went to law school and at the University of Florida, became a lawyer. Then I went to NYU, New York University in New York, and got my advanced law degree in taxation, United States taxation. And then I didn't do international. And then I have my final degree is a global MBA from the London School of Economics, which gives me a really good macroeconomic foundation globally, which is really what is necessary right now. And so from that multidisciplinary perspective, I bring to you Crashes and Taxes, which is my practice's perspective of what's coming. And so I love this quote from Plato: to those who are able to see beyond the shadows and lies of their culture. So every culture has had their shadows and lies, but the shadows and lies of their culture will never be understood, let alone believed by the masses. I include this because I want you to understand that we are an outlier. We are a disruptor. We are going against the mainstream propaganda coming out of Wall Street, which is to tell you that everything is fine and we will have a soft landing. We might not even have, we're going to avoid recession altogether. And when you start to bring up the data that is contrary to that, you're going to get pushback from people, and you need to understand where is this coming from? Because when people start to believe what you're saying and accept what you're saying as it's going to come to fruition, then they have to accept the fact that they're not prepared for what you're saying and that they need to take active, proactive steps to get prepared. And people aren't really prepared to do that. A lot of people aren't prepared to upend their investment structure that they have. They've been so indoctrinated to hold over the long haul that even when the economic writing is on the wall, they still will not make changes to their portfolio because they're holding for the long. So, this is problematic for a lot of people because of what is coming. So again, we're today talking about the top 5 economic indicators that Wall Street is wrong and that a soft landing is impossible. And I'm going to make my best efforts to give you an economic case of why this is not going to happen, and the truth is being obfuscated from us. Okay. So the first thing I want to start with is everyone jumping on the bandwagon that everything is going to be fine. So you can see this is July 27. Again, this recording of this date is August the 9th. So you guys will see it probably next week early. And you can see here Bloomberg, you've got July 27, Bloomberg, economists seeing signs of soft landing for US. Here's why. And so here's where they just basically talk about that Powell has been able to raise prices and see a pullback in the broader price points, CPI specifically. However, it hasn't yet impacted and created a rout in production or the actual, work of consumption. So that's what a soft landing would be to slowly increase the cost of goods and services so that we don't have an overall economic slowdown, i.e. recession. You can see here, this is from August 2nd out of Reuters. Bank of America Global Research raises U.S. growth forecast on soft landing expectation. So here we go. At the end, I'd say mid-July, end of June, mid-July, we started to see investment banks really become convinced that a soft landing was absolutely going to happen or possible. And then you can see Bank of America, actually their research arm, switched and now agrees that there will be a soft landing and that we would probably avoid recession altogether. Here's the Wall Street Journal, and this is also this is mid-July, July 16th. Markets appear convinced the Fed can pull off a soft landing. So you can see I've got Bloomberg, we've got the Wall Street Journal, we've got Reuters with Bank of America, and then we've got, let's just read this actual because I included it, so there must want to have read it. Markets convinced the Fed can pull off a soft landing. Stocks have surged. You can see that the stocks have really gone since June, July. There's an actual chance here the Fed could stick the landing, says Dryden Pence, Chief Investment Officer at Pence Capital Management. Still, there are reasons for concern. The Conference Board said last week that its leading economic index fell for the 15th consecutive month, signaling slowing economic activity ahead. That is the index's longest streak of declines since a span from the spring of 2007 through early 2009, i.e. the global financial crisis. The U.S. economy fell into a recession in December 2007 and didn't exit until June 2009. The bond market is flashing another warning sign. Normally, longer-term U.S. treasuries carry higher yields than short-term ones, paying investors for the risk that interest rates rise or inflation accelerates. When the longer-term yields are lower, it often suggests that investors think the Fed will need to cut rates to resuscitate the economy. The yield on the benchmark 10 has been lower than that of the 2 for more than a year, the longest streak since a span ending in 1980, according to the Dow Jones Market Research market data. So here is CNBC. This is August the 6th, 4th. Soft landing, no recession. Bank of America now predicts. So I want you to understand that we are clearly seeing a shift economically where both economists at market research and investment banking firms are now saying, okay, the Fed has done it or will be able to do it. They are going to be able to achieve a soft landing in the midst of not having a broader recession or economic pullback. And so everyone now is kind of, not everyone, there's disruptors like I and contrarians like myself, but most people are now starting to see, oh, yes, we can get a soft landing and there's not going to be a recession. And so I'm trying to make the case and build the case for you that this is not the case. So here you can see the NASDAQ 100, and this is the return year to date. And obviously in 2022, we lost almost 33%. But year to date, we are up almost 40%. It was up over 40%, but pulled back with a couple of days that we've had since Moody's has downgraded 10 banks, which we'll talk about today. Here you can see the S&P 500. It's a little bit broader, so I couldn't get last year. They were obviously down almost negative 20 with, without dividends. If you include dividends, negative 18. And year to date, 18.32%. And then the Dow, you can see negative almost 9% in last year, and then year to date, 6.54%. So the question is, with such great stock market year to date results, and everybody saying soft landing is going to happen, why are we not in agreement? Why are we saying these results are not going to be standing by the end of 2023? Let's get into it. Economic indicator number 1, yield curve inversion. This is a market insider report from June 29. This recession indicator flashed again as the Fed signaled more rate hikes. It hasn't been wrong for 44 years. So yes, what we are talking about here is the yield curve inversion. Banks borrow at short-term rates, either through overnight lending from other co-banks, or they borrow directly from the Fed. So we've got the Fed funds rate, and we've got, basically the overnight rate. And yeah, I mean, this is a problem when banks are borrowing at the shorter term higher rates and the longer term rates are lower. They're locking in interest, just like the Fed. The Fed has the exact same problem now. The Federal Reserve has $8 trillion of some sub 2% yield on the instruments that they're holding, but they're paying out, much higher rate on overnight repos for their, open market operations. So this is a massive problem that the Federal Reserve is a net negative interest rate situation. They've lost over $980 billion, the equivalent of $980 billion in asset value. And now we're clipping $100 billion off, supposedly, of the balance sheet on a monthly basis, which is not happening because I can see the M2 supply going up. So this is the problem. And let's see what Market Insider explains. The closely followed spread between the 10-year and 2-year Treasury deepens to minus 100 basis points Wednesday, according to the Federal Reserve Bank of St. Louis. Meanwhile, the gap between the 1-year and the 30-year government bond yield reaches its most inverted level since 1981. 1981. That is 42 years ago. So we're talking about 4 decades of worth of data. Modern era, China World Trade Organization outsourcing the global economy output to China and the East, to the West. All of that has happened since 1981, and it's the first time we've had that large of an inversion since 1981. Now, I'm going to take myself off for just a second because you're going to need to see this. This is my Wall Street Journal. And this was last Wednesday. So it was like July, like the last Wednesday of July. And here you can see that, and this is just my Wall Street Journal app that I constantly am monitoring. You can see that the 10-year was 3888. And if you come over here, you can see that the 2-year was 4903. That is over 101 basis points. That literally is 101.5. So that is basically 101.5 basis points. We're talking about a massive inversion that has been sustained now for over a year. That again is the largest since 1981 modern finance timeframe. We've got the Wall Street Journal here. This is from August the 9th today. Bank problems aren't over, according to the bond market. Now, this is going into the fact that Moody's downgraded 10 banks and put 17 others on a watch notice list for additional potential downgrades. So this is a problem because now these banks are going to have trouble issuing their own bonds because of their downgraded rating. And we can see that because banks are borrowing short term and lending out on the longer term, this locking of this inversion, the shorter term rates being lower than the longer term rates, this is a big problem for banks. And this is on top of the fact that we're already in a liquidity problem since March, which we are covering. Okay, and then we have here the Fitch downgrade, which this happened at the end of July, beginning of August, where we again were downgraded. And the thing that's the stressful and most frustrating thing is that it wasn't even a blip. You know, I think a couple of Fox Business shows, Bloomberg, but we had hardly any analysis. We certainly didn't have anybody from Washington talking about, we certainly didn't have Bidenomics or this administration talking about how this higher cost of capital now for the United States, this means our costs at the sovereign level are more expensive. And nobody has addressed the fact that we are losing our sovereignty. Our sovereignty is being downgraded by previously S&P, now Fitch. Why? Because they understand that we have printed too much. We have gone too far. So now we see that we are even again in modern time, once again, downgraded in ratings, and that our own issuance of our own debt will cost us more. So the fact that the yield curve has been inverted for over a year, the fact that the banks are already having liquidity problems because people have withdrawn money from banks and the fear of bank solvency. They have drawn money from banks in order to buy precious metals. They have withdrawn money from banks to have cash at home because the banks are starting to implement what we call the bail-in measures. You really need to check your consumer agreement with your bank and find out what kind of liquidity restrictions they can apply, usually up to 90 days on your accounts, that you understand what kind of bail-in measures would or could be applied by your bank in the event we have the economic black swan that we are expecting to happen. We're expecting, just to not hide the ball, which is a law school term, but to just show you and lay out what we're expecting. We're expecting a black swan economic event at the end of 2023, between now and the end of 2023, that will set the world into a new world direction that we've been discussing now for over probably close to 2 years, but certainly since coronavirus, so going on 3 years. And so what that means is we are preparing for that black swan event. So what we would be doing and should be doing in the event that it is, in fact, absolutely a black swan, which is what our clients are prepared for. So you can see, let's move on to economic indicator number 2, and that is a liquidity issue, and that is the M2 money supply contraction. Now, M2, we will read the definition, but I need you to understand that this is one of the most fundamental economic indicators of coming crisis, especially for a consumption-based economy, which the United States of America is a consumption-based economy. We pretty much derive over 70% of our GDP from the consumption of, goods, and services rounds up the rest. So we are such a small percentage as a manufacturer ourselves, and we are much more of a consumption nation. China and the East produces it, and we in the United States and the West consume it, or the first world nations, which is America, Europe, Canada, Australia, New Zealand, and Japan. That's what we consider the West. And we will be making differentiations between the West and the East as we continue. So the M2 money supply contraction is a big problem. This graph is hard to read because it's literally going back all the way to the 1950s, middle 50s. But you can see that our money supply has done nothing but grown. This is an exponential high growth, and it grew up exponentially in 2020 coronavirus. And then we have it declining. And that, in fact, is the problem. We have an M2 money supply contraction, which is indicating a liquidity problem. Now, the Federal Reserve is supposed to be QTing quantitative tightening, but because of the fact that short-term yields are so high and banks are having liquidity problems, we actually start to see it tick up a teeny bit from its pullback. And that's about a 1% tick up. We're going to quantify these numbers for you. And you're probably like, I don't even understand. What is M2? What does it even matter? And we're going to get there. So this is an article from March 30 when the banking crisis really kicked in earnest. You can see this Reuters column, U.S. money supply falling at the fastest rate since the 1930s. And that, in fact, is the point, that this M2 money supply contraction has not happened since the 1930s and the Great Depression. So I am really irritated, especially about M2, because there's a lot of economists that are talking about excess liquidity, and they are not talking about the current situation. They're talking about we had in the past, through coronavirus stimulus, excess liquidity of almost $1 trillion that had to be burned up through the system. And that is what has allowed this to take so god awful long. These economic terrible things that have been happening that have completely crashed the global economy, it's because so much excess liquidity was printed through the coronavirus pandemic. But now we're seeing the M2 contraction that hasn't happened since the Great Depression. And that's getting lost in translation. It's not getting through. The only thing that's getting through is that the stock market is booming. And so people see that and they think everything is fine. And because of that, I am really going to take my time to walk through this Motley Fool article to explain to you M2 and what is the problem here. Here's Motley Fool. This is June 4, so this is pretty timely. U.S. money supply hasn't done this since the Great Depression, and it implies something big for stocks. M2 money supply has made history twice over the past 2 years. The largest contraction in the money supply since 1933 made bode poorly for the U.S. economy and stock market. However, widening the lens, we do have some indicators that there could be a sign of relief. And that's the article really just talking about the fact that the unemployment in the labor market's been strong. And we're going to talk about that too. So let's really get this for you guys so you can understand M2. Historic moves in M2 imply big volatility to come for Wall Street. Dating back more than 6 decades, M2 has pretty consistently, 6 decades is 60 years. M2 has pretty consistently expanded. Between January 1959, it was $286.6 billion, and April 2023, where it was $20.67 trillion. Stop, pause. Now, in the perspective of absolute growth between 1959 and 2023, you would expect that it would go from something in the billions to something maybe more in the billions, like a 5 or a 10x. But to go from 286 billion to 20 trillion. Wow. M2 has expanded an average of more than 3% per year. So that means our liquidity in circulation, M2, is literally all cash, all savings deposits, and money market accounts of $100,000 or less that have check writing privileges. So it's pretty much everything that's in circulation and could be written on a check and instantly cashed and made into cash. And so it's expanded 3% per year. Since the U.S. economy spends considerable time expanding relative to contracting, having more physical capital available for a growing economy isn't surprising. What is surprising is what the M2 money supply has done over the past couple of years. Here's a warning. The money supply is officially contracting. This has only happened 4 previous times in the last 150 years. Each time a depression with double-digit unemployment has followed. Each time a depression with double-digit unemployment rates has followed. So I want you to understand this is a big deal. I'm going to try to read this. It's a little bit small for me. Between the early part of 2020 and the early 2021, the issuance of stimulus checks and other financially supportive programs during the COVID-19 pandemic allowed the M2 money supply to balloon 26% in a single year. Again, allowed the M2 money supply to balloon 26% in a single year. Based on back-tested data from the U.S. Census Bureau and Federal Reserve Bank of St. Louis, Reventure Consulting founder and CEO Nick Jarrell notes this was the largest expansion of M2 in 153 years. Although rapidly expanding the U.S. money supply seemed like the right thing to do to support workers who had bills to pay during the pandemic, doing so has had serious consequences. Historic expansion of M2 allowed the inflation rate to surge to above 9% in June 2022, the highest year-over-year increase in over 4 decades. It also coerced the nation's central bank to get aggressive with its rate hiking cycle. With the Federal Reserve doing everything in its power to cool off the prevailing inflation rate, M2 has now reversed course. For the first time since the Great Depression, the U.S. money supply is contracting. Since 1870, there have only been 5 instances where M2 declined by at least 2% on a year-over-year basis. 4 of these events occurred between the 1870s and 1933, leading to 3 depressions and 1 panic. The 5th incident is ongoing, i.e., happening now. Since hitting an all-time high of 21.7 trillion in July of last year, 2022, M2 has now declined 4.8%, representing the biggest drop since 1933. The reason declines in M2 are concerning is twofold. First, the decline in M2 money supply is typically associated with a higher probability of an economic slowdown. If the inflation rate remains above its historic norm and there are fewer physical notes in circulation to buy goods and services, we usually see discretionary spending drop off. So basically, this drop in the money supply is in fact a precursor, or it has been every single time that it's happened in modern time, which it hasn't happened since 1933. It has been a precursor to recession, in fact, depression. And again, the last time it happened, it was the beginning of the Great Depression. So I just want you to understand, in the sea of propaganda of how great everything is, we are at depression level liquidity issues. History suggests that the worst of the market declines happened during the recession. I'm moving on to this now. It's in the same article, but a lot of people are just seeing soft landing, no recession. And again, I want to point out to people they're misreading the data. So you can see history suggests the worst of the market declines happened during an actual recession. Since 1929, around 2/3 of the SPX, so that's the S&P 500 total return, peak to trough, drawdowns have occurred during, not before, U.S. recessions. So the other issue is that recessions bode poorly for Wall Street, at least in the very short term. Over the past 95 years, approximately 2/3 of all downside in the benchmark of the S&P has occurred after, not prior, but after a recession has been declared. Now, remember, even though Biden tried to change the definition of a recession, it's 2 consecutive quarters of economic contraction, GDP economic contraction in a row. So what's more, no bear market. I don't know if I can actually read this. Let me just see here. What's more, no bear market after World War II has found its bottom prior to an official recession declaration by the 8 economist panel of the National Bureau of Economic Research. That's 12 recessionary bear markets, all ending after a recession has been declared. So what we're trying to basically let you in to the insight here is don't think that just because everybody's said there's no recession coming, everything's fine, soft landing, that is in fact where we are, because we just aren't there. That's just not where the data is showing us. And then we have a whole nother huge issue that would weigh on the global world, and that is China. China is actually, the economy is doing quite badly. And outside of their de-dollarization efforts that have gone extremely well, they are potentially going into deflation. And that is a huge warning for the global economy. And it has already affected, like we saw, Maersk. We'll talk about that coming up on another economic indicator. And all of these are kind of interrelated and correlated to each other, you guys. So I'm trying to put them in the right category, but we will discuss multiple issues in multiple areas. And so we've now got global factors that the whole world is absolutely feeling this. And here it is. Shipping giant Maersk, which is Danish, largest shipper in the world, shipping giant Maersk, they are the benchmark for global shipping and global trade, warns of sharp slowdown in global trade as it reports trade profit. So let me just read this here. The world's second largest shipping company, often seen as a bellwether for global trade, posted a second quarter profit before interest, taxes, depreciation, and amortization, what we call EBITDA, of 2.91 billion. Now that was a beat. They beat. But the problem was this was well below their record 10.3 billion for the same quarter, Q2 of 2022. Analysts had projected an EBITDA of 2.4. So they beat their analyst projection. However, they miss almost substantially from year over year what they did last year. Then they warn of a deeper pullback in the global shipping container demand. And they now expect, they had initially in Q1 and at the beginning of the year had their projections to be 2.5% as how much global trade would and shipping container demand would fall. Now they're saying it's going to fall as much as 4%. And that was quite a big jump from their worst case scenario that they had said worst case scenario was 2.5 at the beginning of the year. They're now almost doubling that to say, no, we're going to say it's actually 4. So even though their profitability was a beat and they actually did better than expected on the analyst side, because they have now projected that they are expecting much bigger fall off in global trade, they're projecting that things are slowing down. So let's go to economic indicator number 3. This is probably the one that is most integrated into every other 5 factors. And that's because it's banking. And every entity across the globe uses some kind of financial, capacity to operate their business. So banking and specifically commercial lending tightening, which is a massive liquidity issue. And it's seen consistently every time before recession and depression. And it is again rearing its ugly head. So we have the slews here, the Senior Loan Officer Opinion Survey the Federal Reserve conducts on bank lending practices every quarter. We had the Q1 definitely showed bank lending tightening, but here it is. The July has come out, July 23rd, and we can see the results. And that is that, yes, in fact, banks are now tightening lending standards across the board. So here's the Wall Street Journal, where you can see that it had already happened. This is a 3-month ago article. Lending standards tighten in first quarter, banks say. So we already knew that Q1 had tightened, but now we have the second Q2. And what's happened? They're tightening even more. Now, here's where I want to show you some propaganda just to get you on the lookout for how this has happened. When the media has to put out bad news that can't be avoided, they try to come up with some kind of cutesy title that could obfuscate the truth of what the article's talking about. When it's good news, it's direct, right to the point. No recession, soft landing's going to happen. No recession, everything's fine. But here's some bad news, and look how they write it. Banks are going on a diet. What does that even mean? Do I know if that's bad or not? Banks going on a diet. Does that mean they're going to cut staff? They're going to cut branches. They're going to cut, infrastructure. They're going to cut overhead because the branches are no longer being used. What does that mean? It doesn't sound like bad news, does it? It is. It's horrible news. But this is how they explain it. Regional lenders are cutting back on some lending to preserve capital. This is July 24th. This is such a disillusion of what's the reality is. And this is to give you the news and say that they published it and say that they told you, but to not make it sound what it really is. Here's Reuters. U.S. banks report tighter credit, weaker loan demand. The Fed survey shows. Same Fed survey that we're just talking about, July 31st, just came out, week old. I obviously kind of want to read this because it's on here. So I want to we have to understand these problems, you guys. So let me just try to actually read this. So this is July 31st with Reuters. U.S. banks reported tighter credit standards and weaker loan demand from both businesses and consumers during the second quarter. The Federal Reserve survey data released on Monday showed evidence that the central bank's interest rate hike campaign is slowing the nation's financial gears as intended. The Fed's quarterly senior loan officer opinion survey, or SLOOS, also showed the banks expect to further tighten standards over the rest of 2023. There it is. That's the big thing. Yes, they're saying we've tightened. And guess what? We are going to tighten more. Of course, the Federal Reserve just came up with new guidelines for liquidity for banks that have $100 billion. But let's just keep going. The most cited reasons for expecting to tighten lending standards was a less than favorable or more uncertain economic outlook than expected, as deterioration in collateral values and expected deterioration in credit quality of commercial real estate and other loans, the Fed said. So let's just digest that. The reason that we are going to have additional tightening was because we have a less favorable economic outlook, or an uncertain economic outlook. So that right there, if all of the banks are saying the economy outlook is uncertain and therefore we must be more cautious on loans, then we don't have everything solved or soft landing and there's no problem. We still have big problems that banks are taking to make it harder to get loans, which would only then exacerbate whatever economic problems we're having. It's a catch-22. Then it says the expected deterioration collateral values. Oh, what does that mean? That means the banks are saying that we are going to have real estate collateral values come down. They are expecting deterioration in collateral values. Well, banks outside of business lending and capital project lending, they're lending on real estate of some kind. So they're basically saying that they expect that real estate is oversold, overbought, too high, and it's got to come down. That's what that says. And then they're saying, and an expected deterioration in credit quality of commercial real estate. Now, that is a whole nother huge issue. Look at New York City. We're at 40% vacancy in commercial real estate. It is bad. This is the result of the hybrid solution and not going back into the offices. The urban centers are blighted, and this is going to continue because we are now in a new world of office work, and it will never be the same as it was, which would be 5 days a week of office work. That is not going to come back, at least no indicators that I can see of as of this time. The Fed has raised interest rates by 5.25 percentage points since March of 2022, and its surveys and hard data have shown banks have been slowing their lending in response. Monday's SLOOS report, which the Fed policymakers had in hand last week when they decided to deliver an 11th interest rate hike after skipping one in June, suggests credit tightening is ongoing. You've got lending conditions tight and getting tighter. You've got weak demand, and it gives a picture of a pretty tight credit conditions in the economy, Fed Chair Jerome Powell said last week when asked about the survey results. But it does not point to a rush to tighten, the kind that Fed policymakers have worried would occur after the bank turmoil in March that might have made them skittish about further policy tightening ahead. Still, it could threaten the Fed's soft landing scenario. The degree of tightening in recent quarters looks pretty significant by broad historic standards, wrote JP Morgan economist Daniel Silver, noting that in the past, such tightening has generally been associated with recessions. The data are not a guarantee of a recession to come, but the tightening is evidence as of late that suggests the economy should slow. The survey showed a net 50.8% of banks tightened terms of credit last quarter for commercial and industrial (C&I) loans to medium and large-sized businesses, up from just 46% in the prior Q1 survey. For small firms, 49.2% of banks said credit would be stiffer. than the previous month at 46.7%. Both measures fell short of the 70% plus levels that were reached at the height of the pandemic in 2020. So really in 2020, banks said 70% of us, we're not going to lend. And that, of course, would only make sense. We're not in a 2020 pandemic, so that's not really that interesting. However, the largest increase these are the largest increase in bank tightening since the Fed's first quarter of 2009 during the Great Financial Crisis or the global financial crisis. Demand for C&I, which is commercial and industrial loans, remained weak, though not to the degree reported at the previous survey of the first 3 months of the year, when bank demand for credit was the softest since 2009. The latest survey conducted in the last 2 weeks of June, that the net share of banks reporting stronger demand from large and medium-sized firms was negative 51, down 50, almost 52%, compared with 55% from the previous period. So banks are absolutely tightening credit. And this is a problem for a consumption-based economy where the Federal Reserve isn't stimulating, because the Federal Reserve is on a QT. They're not QE. They're not quantitative easing. They're QT. They're quantitative tightening. It's supposed to be $100 billion a month. It's not happening because I can see the Fed is actually starting to do some I can see that their balance sheet is going up. So we believe that the Fed is doing some soft QE, even though they're supposed to be in the middle of QT. But the bottom line is bank tightening credit is going to be a problem. It's going to be problematic. And let's go here now and read this one. This is the National Association of Home Builders. And this is a really great summary. Again, also August 9th. According to the Federal Reserve Board, July 2023 Senior Loan Officer Opinion Survey, SLOOS again for second quarter 2023, bank lending activity. Banks reported that lending standards tightened for all residential real estate, RRE, and commercial real estate, CRE, loan categories. Banks expect their lending standards across all loan categories to tighten further over the second half of 2023. Expectations of more tightening were fueled by increased economic uncertainty and expected deterioration of collateral values and credit quality of existing loans, according to respondents. And that's because the cost of capital is so much tighter and there's so much that has to be refinanced in the next 5 years that it's going to be harder to qualify because your payments are going to be so much bigger. That makes you a harder credit risk because you now have to support a larger debt percentage burden than you previously had to. As standards tightens, banks also reported weaker demand for both residential real estate and commercial real estate loans. The net share of banks reporting weaker demand averaged 38.9% across RRE loan categories, a large improvement from the 50.8% that was the fourth quarter of 2020 and the 87.4%, which was the first quarter of 2023. So we're becoming basically there's more demand in Q2 than there was in Q1 and Q4, which makes sense because people are believing that the market is doing really well based on all of the information coming from Wall Street. 71.1%, a majority of the banks tightened standards for construction and land development loans, while 63.3% tightened standards on loans secured by multifamily properties in the second quarter. Additionally, roughly half of all respondents indicated weaker demand for these loans in the second half relative to first quarter. So this is just a National Home Builders Association just also acknowledging that we've got some problems ahead because demand is slipping and we have higher rates. This is another issue. We're not going to get into this, but we do have multifamily real estate. We still have shortages, but this is a Wall Street Journal article from August the 7th talking about we have $1 trillion of multifamily investment property refinancing that is coming due in the short term. And right now, it's not the best time for multifamilies to be refinancing because all of commercial lending is upended. And then we had this happen just this week where you saw that Moody's, this happened on Tuesday, Moody's cut the rating agents, the rating of 10 U.S. banks, and they put some big names on downgrade watch, which is quite shocking. The lenders that are receiving official downgrade and ratings, M&T Bank, Pinnacle Financial, BOK Financial, and Webster Financial. Major lenders, Bank of New York Mellon, U.S. Bancorp, State Street, Truist Financial, which used to be SunTrust, it's one of the larger institutions, Cullen and Frost, Bankers, and Northern Trust are now under review for a potential downgrade. So that's getting to some bigger Truist and State Street. State Street is actually quite large. Obviously, Mellon. It's not. These aren't small entities. Any kind of downgrade is a recognition that once again we are not in the fruition of stability economically and financially, and we are in fact on the precipice of big downgrading problems. And that is something that the market needs to be understanding. And this is Yahoo Finance this week. Stocks fall as Moody's bank downgrades adds to the August woes. So I just want you to know that there is a lot of pressure in the system. There's a lot of banking pressure, lending pressure, liquidity pressure. And now we have this. And then Politico saying, could banks actually screw up this soft lending? Could the Fed have gotten it all exactly right? And then the commercial banks come in somehow and they screw it up. And this was a really interesting read. So I pulled a little bit of it here. I want to just read a portion of this to you. And just to make this a little bit bigger for myself. Moody's announcement that had lowered the ratings of 10 small and medium-sized lenders was a sign that the mini banking crisis that ruled Washington and Wall Street earlier this spring might not be over. The rating service also cautioned key institutions, BNY Mellon, State Street, and Northern Trust, as well as Truist, and super regionals, which is, again, this is why I'm telling you, it's pretty big. Super regionals, Truist, and U.S. Bank, that debt downgrades could be imminent. That's the last thing the White House allies want as they hop aboard the Bidenomics bus. If Wall Street sours on the banking sector, it could create a new challenge for lenders after they've already said they expect to toughen loan standards in the months ahead. Credit conditions have tightened materially this year and are now more consistent with the hard landing than a soft landing economic scenario. Daryl Cronk, Chief Investment Officer of Wells Fargo's Wealth and Investment Management Division, told MM. The challenges facing certain financial institutions aren't as immediate or acute as what hit Silicon Valley Bank in March. Even if the cascading failures that regulators feared when they backstopped uninsured deposits and at SVB and Signature Bank never materialized, Moody's still sees trouble. With interest rates expected to stay higher for longer, this is very key, you guys. We're already on the precipice of a massive downturn. And with the banks telling us in their Q2 survey that they are going to tighten for the rest of the year, we are basically ensuring our economic recession and or depression because we are a consumption-based economy. And if M2 is contracting and money lending is tighter and people are not refinancing, we are guaranteeing a recession or depression. There is, I'm going to just read this last little bit here. Of course, there is a raft of data that shows the economy is faring well. Last month's growth. Just try to get this. I cannot read this last little paragraph. Of course, there's a raft of data that shows the economy is faring well. Last month's growth reading was solid and unemployment remains close to historic lows. Inflation has started to recede, though we will learn more with CPI that comes out this week for July on Thursday. While second quarter earnings have been pretty blah, there hasn't been a market route. So basically, this article is just stating that, yeah, things have been pretty, this is Politico too. This is just this week. Yeah, just today, actually. Will we actually have a screw up on the soft landing? So let's keep going. And then you can see because of the Moody's downgrade of the 10 banks that we did have a sea of red this week. And also the Chinese data that shows that exports from the second largest economy tumbled in July. So we've got softening global weakness of global trade. We have China, which is our largest trading partner, going into deflationary times. We have Moody's downgrading banks. We have M2 money supply contraction, creating a liquidity crisis right when banks are saying they're tightening again, and they're going to continue to tighten into the rest of the year of 2023. So I think we're 3 factors in. Let's get to our 4th factor. Labor weakening, leading indicators, and global trade fall off. Again, these are all interrelated. We've already gone through the Maersk global projection. But here we go. I want you to see that that Powell has been so successful so far after 11 hikes of rates, the fastest pace ever. He's been successful because he has had one thing working for him, and that has been a very, very tight labor market. And now I'm starting to see leading indicators that are very recession, depression forecasters that are showing that labor is tightening and softening. And we are going to start to see now a change in the ability for labor to stay secure, because we are starting to go into the actual time frame of recession. And so what has Powell been able to rely on to keep his plan going? And that has been inflation and wages. We have had over 10, not now, we have under 10 now, but since 2020, we have had anywhere from 10 to 11 plus million job openings. A lot of people left the workforce completely in 2020, realized they had enough money not to go back and to deal with it again, and they haven't returned. A lot of people started working remotely and decided, I don't need to work at all, haven't returned. Because we've had such a rout of workers, this has been the hardest period for me to hire for the firm ever. And I've talked with a lot of employers that have owned businesses for decades, and they are similarly seeing that this is an impossible job market. So what's happened is there's so few workers that want to work and there's so many job openings that we've had wage increase. We've had wage labor increases, and that has been able to keep the economy from tanking with Powell's aggressive, 11 rate hikes. The economy normally would go immediately into some kind of tailspin, but because workers have been able to demand more for their work because they are so in demand right now, we have continued to see CPI go up. It's just now obviously coming down. So I just want to make the economic case here that the reason that Powell has been so able to continuously raise for all this time, 11 raises, is because of the labor market. And I'm making that as an economic point because I'm going to show that that is now changing. You can see here, this is from December of 2022, U.S. job report, rising wages pose a problem as hiring remains strong. So the entire time that we've been going through all of this, it has literally been a situation of Powell being able to continuously raise for 11 consecutive times, even though he took a pause in June, because the wage progression has increased and the labor market has been so tight. And you can see here, this is a Bloomberg article, and this is from, oh my goodness, these things. This is from February 7th of this year, and it says Powell says further rate hikes are needed and the markets take heed. And why does he say that? Because it's going to take time to cool prices and we have to do more. And again, it is about the labor market. It's going to take time with such a hot labor market to really cool down wage inflation, get people to realize, okay, I'm not making actually more. And so, and to stop spending. So it's all related. The cost of inflation and wages and labor is so interrelated. So Powell has been completely buoyed at doing his 11 raises because he's had a labor market, a sea of labor that has just allowed him to really just bash cost of capital. Now, I want to give a credit out to Steve Van Meter, who's an economist that I love to follow his work. And he really brought this home with this leading economic indicator that he's highlighted for us here. You can see average weekly and hours of production of non-supervisory employees. So this is non-employee supervisors. And what is their weekly hours of production? That's the blue line. And this goes all the way back to the 1960s all the way to present day. Now, the red line is the 4-week moving average of initial unemployment jobless claims. And these two are interrelated. What ends up happening is when you have rising wages, employers have to compete for employees. So they will go out into the marketplace and they have to offer the marketplace rate, or they're not going to get anyone to come. So they have to offer the market price. So maybe before they were offering $15 an hour, and because of inflation and no one wants to work, there's less workers and there's a lot of demand for workers, we now have to offer $20 an hour to get that person to say, yes, I'll come in and work an hour for you. So it went from 15 to 20. We had wage inflation. We had, wages increasing faster than the cost of the rest of the world increase. That's just pure wage inflation because of a tight labor market, and all induced by the 2020 and, a lot of like airline pilots. We had a lot of airline pilots that retired and we weren't prepared for that. And we can't really handle it. I mean, some of my direct flights are completely canceled. I'm having to take layovers now. We have a massive airline shortage in this economy and this country. And the pandemic is what brought that to the forefront. So what you can see here, and let's go back and look at like this period here of the 1985, like depression, correction, recession. You can see here that, we had rising wages just like in 2020. And then immediately weekly hours of production crashed down. And the second that it crashed down, what happened with the red 4-week rolling average jobless claims? Straight up. So what ends up happening, and what we're seeing happening now, is after all of the wage inflation that has happened with non-supervisory employees, now that the economy is actually cooling and beginning to go into a recessionary time frame, you're starting to see demand drop. And as demand drops, the employers don't need all the workers for that many hours. So they can't cut their hourly wage now. They cut their hours. So anytime we start to see average weekly hours of production coming down like this, we expect, and we again are seeing, the 4-week initial jobless claims going straight up. And this is where the labor shift has begun now. I would say in the last 2 weeks, we're starting to see weekly hours of production come into recessionary, depressionary timeframes, as we've seen in all of these other gray spots, which are the recessionary timeframes. Here's the global financial crisis, and you can see they cut hours of production, and the 4-week rolling average came up immensely. Anytime we're in a recession and we're cutting hours of production, you're going to see the 4-week rolling initial claims go up. And so what I'm presenting to you is the fact that I believe we're starting to see the beginning of a labor shift, which probably means that Powell is not going to have the underlying labor support to deal with these robust interest rate hikes that he's doing. I have a feeling that CPI is going to have 1 month of a tick up here. But this is indicating that CPI should be coming down as people's hours are getting cut. They have less money to spend. Less money to spend means less money to buy things. Less money to buy things means the demand drops. Demand drops. That means prices drop, and prices dropping mean inflation comes down. So this is the beginning of a shift in the underlying strength of the robust labor economy that we've had since 2020. And I think Powell needs to take note. I would expect we're going to get a pause for this next one, and I believe maybe October if we haven't had a black swan. All right, now we're getting to our fifth and final economic indicator, and that is that we are at the end of dollar hegemony. We are at the birth of multipolarity through specifically the BRICS and the East. And we will be moving to more of a regional world. The US dollar is not going anywhere. It will still be a global reserve, but it will not be the sole global reserve, which means that the power is going to be taken away from those that run the global financial world of just money creation that is untethered and untied to any economic reality of real hard asset values. And that is a wonderful thing, because I want you to understand when the money supply is easily manipulated as it currently has been in this country since we decided in 1944, Bretton Woods, New Hampshire, to be the world's reserve standard, the US dollar, we, as we talked about the money supply, some, 280 billion to some 21 trillion. Like, the amount that we have inflated away from reality is the issue that this 5 is dealing with. There is a global change coming to the reserve currencies. This is an article from March of this year talking about BRICS, now specifically India. So BRICS is Brazil, Russia, India, China, and South Africa. In South Africa, the BRICS nations are meeting this month, August, in Johannesburg, South Africa, to admit their new formal members that have applied. We know the UAE, United Arab Emirates, has applied, and we're expecting that Saudi Arabia has made an official application as well. When Saudi Arabia and the UAE join BRICS officially, that would indicate that they would be moving towards selling crude oil outside of the dollar. And that would be the death of the petrodollar that was birthed in 1971 when Richard Nixon took us completely off the gold standard in August of 71. Finally, the final nail in the coffin from FDR's kind of coming off of it with World War II. But in 1971, we completely came off of it, and that created inflation because we had no tether to a true value, store of value, a real hard asset. So that's when President Nixon sent over Secretary of State Henry Kissinger to meet with the King of Saudi Arabia and say, hey, we'll be your military if you will agree to sell all crude in US dollars. Not only you, but all of the 13 OPEC nations that they are part of, that they are one of. So all the other 12 OPEC nations that you control. And eventually they got Russia in there, which became OPEC plus. That all ended when Russia invaded Ukraine in March of 2022. The US petrodollar ended completely in 2022 because Russia no longer accepted dollars for trade for whatever they would sell. And they're obviously one of the largest producers of crude and natural gas in the world, especially to Europe. And so the Indian rupee, and India has done a lot of independent autonomous work this year and last year, I'd say in the last 3 years, to really start to get countries to bilaterally trade with them in their own, native rupee, which is unbelievable. The rupee is close to becoming a global currency. Once you have 30 countries that trade in your currency, the IMF has no choice but to name you a global currency. This is a Goldman Sachs intelligence white paper printed July of this year on how India could rise to be the world's second biggest economy. This is not a pipe dream here, you guys. This is serious stuff, that India has really made a global play at being a global currency. And certainly with their 1.3 billion people, just 100 billion people under China at 1.4, we can see that their economy of scale is massive. I need to share my screen. I want you to understand this is the Bank of International Settlements. And this is a statement by one of the managers of the Bank of International Settlements regarding central bank digital currencies, and specifically what the Bank of International Settlements would potentially want to be seen, and why those things are good. So let's have a listen to this.
We tend to establish the equivalence with cash, and there is a huge difference there. For example, in cash, we don't know, for example, who's using a $100 bill today. We don't know who is using a 1,000 peso bill today. A key difference with the CBDC is that central bank will have absolute control on the rules and regulations that will determine the use of that expression of central bank liability. And also, we will have the technology to enforce that. Those two issues are extremely important, and that makes a huge difference with respect to what cash is.
Wow. So basically, what they're saying is they will have a rule-based system. Hold on, let me pause this. I hate when they just autoplay. It's like I did not autoplay you. But what I'm pointing out, you guys, is that this is a fundamental shift of absolute epic proportions. This is a unelected official of some kind of central bank. In America, our central bank is the Federal Reserve, which is a privately chartered corporation by private charter passed by Congress in 1913. So the Federal Reserve is not a federal government institution. It is a private corporation. And people don't understand that. But I just want you to understand the Bank of International Settlements is the top central bank of all 81 central banks of the world. And they're sitting on top and they're basically telling you this is not cash. There will be rules and there will be no autonomy. We will know everything that you're doing. And I'm a libertarian and I am for your freedom and your ability to live your life with your privacy intact, without the whole world knowing what you're doing with your life. And certainly the government shouldn't know everything you're spending every dollar on. So this is a new global world that they're trying, a lot of groups are trying to push us to. And that takes me to this white paper that came out from the Bank of International Settlements on June 20 of this year, talking about a blueprint for the future of the monetary system. And this is where they brought out the concept of something called a unified ledger. So what they're looking for is that on the blockchain, the entire earth, every asset, intellectual property, patent, trademark, every pen, speck of dirt, every natural resource, everything on planet Earth, and every human thought idea that's ever been patented or trademarked will be reduced to a monetized value. Everything will be monetized to a number. And then every asset will be listed on what they call a unified ledger, so that everybody on the blockchain will be able to see the entire value of the entire worth everywhere at all times. And we will no longer own actual assets. What we will own are tokens that represent the total net worth that we have. So if you have a house, that house is going to be put on the, and this is what the Bank of International Settlement wants, that house is going to be put on the Bank of International Settlements unified ledger, Walser House, Tampa, Florida, Walser House, New York, Walser House, Tennessee. All of that is going to be monetized as a value on the unified ledger. And then we're going to be basically using tokens. It's called tokenization. And you will not own anything anymore. You will simply have tokens. And what you can say is, hey, I would like to have a house for a vacation in Tennessee. And so let me go out and buy a house, but you will no longer buy anything. You will simply say, how long of use are you wanting this house in Tennessee for vacation? 5 years? Oh, okay. 5 years of use is this many tokens. And so we're going to be leasing everything. And this is coming down to the subscription-based modeling that's been so super successful. It's going to be everything, nothing. You will not have anything that you buy. Now, this is a ripoff completely. It goes back to the should I lease my car or buy my car argument, but to the nth degree. And let me give you an example. Your light company is planning on installing lights in your home that are all IoT lights, Internet of Thing lights that have a smart chip in them that can connect to the light company to tell the light company how much capacity and when it burns out, because the light company is going to lease your lights to you on a maintenance program, and then they will be aware of when the light is about to go out, and they will send someone to replace the light for you because you don't own the light. It's their light that you are leasing with your tokens through them. So this is how the World Economic Forum's and Agenda 2030 United Nations, when they say you will own nothing and be happy, what they're talking about is a new way of a model that all assets are publicly acknowledged, and we all have tokens to lease or use for the period of time of our use this property, but there's no more intergenerational wealth transfer because there's no more wealth. You don't own anything. You simply operate and make enough productive activity to earn tokens that you can then use to buy what you want on a finite period of time. This is a complete revamping of the world. They also have Project Icebreaker, which is basically the equivalent of the BRICS sort of mBridge. It is the digital crypto platform that they want to use for their unified ledger. And finally, we have here de-dollarization, and you can just see that there have been multiple groups that are understanding and studying now what has actually happened to de-dollarize. And really, you can see not a lot has really happened in the 20s, 40s, that we became dominant in the 40s. This is the dollar dominance time frame. Then we had the petrodollar situation happen. We had a couple of things in the 80s. But here in 2022, you can really see that central banks really started to stockpile their gold. They had the largest gold stockpile. This chart was done before the World Gold Council restated their 2022 results, because I initially said that there was the most purchase ever since 1967. They went back and restated after the fact, this chart was made before this, that it was the largest gold purchase by central banks ever since the records had been kept, but that was only going back to the 50s. So the war in Ukraine obviously created sanctions from the West against Russia, kicked Russia out of the SWIFT international payment system. And that forced the BRICS nations, specifically Russia and China, to deepen their cooperation between their financial systems, which is obviously the ruble and the yuan. And that really started de-dollarization, the bilateral trade between China and Russia, and again, the BRICS nations kicking in, and how much India has done to get multiple nations to trade in rupees is just unbelievable. And we did have a Russian finance minister state 2 or 3 weeks ago now that they are going to have an alternative global reserve currency that will be backed by gold. So this is what has happened. We used to be over 80% of all foreign exchange reserves. We have dropped to less than 60%. We have had massive de-dollarization in the last 6 months of this year. That's how fast this is happening. So that is another reason that no, once again, we are not going to have a soft landing. Disruption is imminent. There are a few people that agree with us. This is a JP Morgan article that it's from 8 days ago. So this is basically August 1st, where JP Morgan still says stocks are too expensive. There's a little bit I wanted to read here to you from the JP Morgan piece. The S&P 500 just hit its highest level since March of 2022. JP Morgan isn't letting go of its bear case quite yet. The bank strategists say investors are overly optimistic about inflation's path and the chance that the Federal Reserve and other banks will softly land the economy. JP Morgan strategists are willing to bet that ongoing tight monetary policy will dampen some of this year's bubbly behavior. Equity valuations multiples are not pricing a soft landing, but rather a continued expansion or no landing and simultaneous monetary easing, reduction of interest rates, and or QE. So let me just read this to you again. What JP Morgan is saying is that how equities are operating right now, equity evaluations or multiples are not pricing a soft landing, but rather a continued expansion. In other words, they are trading right now as if we are not in the middle of anything and that we're just going to continue to expand, and as if we still have simultaneous monetary easing, which means they expect rates to go down, and or they also expect the Federal Reserve to start to stimulate again. That's how the equities are being priced right now, which is ridiculous because that is exactly the opposite of what is happening. So you can see that JP Morgan strategist Marko Kolanovic writes, with no interest rate cuts in sight, ongoing quantitative tightening, QT, and our base case for macroeconomic slowdown, multiples appear too high. A host of metrics support Klonovic's view that even if companies are doing well, investors are paying too much for their shares. A few indicators that the rally is looking frothy. The extra reward for holding stocks instead of bonds, the equity risk premium has fallen to its lowest level in 20 years. It's because yields on bonds are so high. U.S. equities are currently more expensive than those of any other country or region. Research affiliate data shows the U.S. stock benchmark trades at multiples of 31, pricier than it has in more than 90% of the time since 1881. Let me just read this to you again. U.S. equities are more expensive than any other country or region. The U.S. stock benchmark trades at a multiple of 31. It's pricier. That's a price earnings ratio multiple of 31. That's pricier than it has been in more than 90% of time since 1881. Overpriced. The stock market is overpriced, on the verge of massive economic problems, and people want to understand why a soft landing is impossible. We're going to end with Forbes. This is an article from July 25th, so pretty timely. As economists see a soft landing, U.S. bankruptcies spike. As the U.S. economy has held up better than expected in the face of rising interest rates, some economists are starting to predict a soft landing or even no landing at all for the U.S. economy. However, the yield curve remains inverted. Bankruptcy rates are spiking and other leading indicators are moving in the wrong direction, which could suggest economic weakness despite a broadly encouraging read from the jobs data and stock prices. So what are the two things that Powell has going for him? The market has held up. Equities are being overbought. They're just completely overpriced, but the market is, it's a psychological, everyone wants to believe, so everyone's believing. And so that's happening. And then we've had a good labor market. That's been the two things. The historical view. Historically, rising interest rates have been associated with recessions. That's one reason. An inverted yield curve is a cause for alarm in financial markets. The U.S. economy has so far continued to grow as interest rates have risen sharply. That's in part due to a robust job market with unemployment remaining at low levels for longer than many expected. Still, based on how inverted the yield curve is, analysis from research at the New York Federal Reserve imply that a 67% chance of recession on a 12-month view as of June. Let's just read that again. We should have, I'm going to read this to you with what this is saying. I'm going to cut through it. I'm going to read to it with what this is saying. Interest rate going up usually means recession. We've had an inverted yield curve, which is an alarm bell. So far, the U.S. economy hasn't gone into recession. That's because we've had a robust job market with really low unemployment for a long time, more than expected. But based on how inverted this curve actually is, we have a 67% chance of recession in the next 12 months. Bankruptcies. Bankruptcies can indicate stress in the economy. Commercial Chapter 11 filings have risen 68% year over year for the first 6 months of 2023. 68% year over year, according to Equip Bankruptcy, based on the analysis of U.S. court records. This sharp uptick compared to last year may suggest the U.S. economy is less healthy than it appears. Really? Bankruptcies aren't the only indicator that is pessimistic. The Conference Board's leading indicators also imply a recession is near. An inverted yield curve is a component of that analysis. New orders, global new orders, and consumer expectations are also weak without many offsetting encouraging signs, leading this series to imply that a recession may be on the horizon. Listen, you guys. This is not a recession or a depression on the horizon. This is a new economic global order. That is what we're going through. It is happening. It's upon us. The last thing I'll just remind you of is that we've had massive warnings this year that we will have some kind of internet apocalypse, and I expect the internet will go down and will be down for at least 3 days, and that will impact your ability to access your finances, which might trigger a banking crisis, which then would be a precursor to them moving us to the new sort of system with central bank digital currencies. But all of this is going to take some time. So I have gone through with you guys today the 5 factors of why soft landing is not happening. It's impossible. We are going into either a recession or a depression under normal circumstances that have this data. But with what is happening with the de-dollarization of the world, with the Russia-Ukraine incident that is ongoing, and the global, world being involved in that, NATO specifically, and then with China really threatening Taiwan, we have obviously geopolitical threats that could pop off anything in our economy. But the economy itself is so weak that as the world de-dollarizes, you're going to see a black swan. And that is what we're prepared for. We're prepared for a bank bail-in where your money is frozen and you need to have cash at home. You should have some precious metals at home and some kind of safe to get through these transitionary times. And then you should really be away from financial derivatives at this time. The stock and bonds, anything as a financial derivative that's based on another entity having to be viable in order to meet those payments is where we would be cautious right now. And we would definitely want to be more on the hard asset space, because hard assets will translate into still value as the world tries to ties everything, reduce everything to the blockchain, and then monetize it through tokenization, which is basically what Sam Bankman-Fried did with his whole situation, is he tokenized the underlying cash. So it's just a crazy time, you guys. I hope that this webinar really helped you guys, have a much better handle on why we're not that keen on a soft landing and the recovery of the U.S. economy without major pain coming. There's major pain coming. Be prepared. Especially with the continuum of government that has been happening in the United States since 2020. I think that's also going to come to play here in this fall. So take care, everybody. It's great to see you all. And until next time, have a great end of your summer. Take care.